Welcome back. We are going to talk about two very important concepts that I think will be directly related to your project and extremely helpful to you. Right now, we're going to talk about accounting for merchandising business. This is chapter 5 of your textbook. Now, when I think about a merchandising business, I immediately think about Target. But for purposes of the class, I want to make certain that you understand that a merchandising firm truly has unique transactions that I think are really important for you to grasp. The transactions relate primarily to the flow of goods. Now, a merchandising business does not manufacture any of the products it sells. In fact, they buy it and they resell it to you and me. In the case of Target, Target would go to different wholesalers of products and line their shelves with their products, including clothing. It could be detergent or household goods. It could be electronics, etc. So they're selling products that have already been manufactured, and so there's no process of that have to be done. What they're doing is reselling it to you and me. So, and also the activities of these types of businesses are going to be a little different. So we want to talk about service. We understand service firms and providing a service, completing the earnings process, and then recording that transaction. But a merchandising firm is a little bit different. So we want to go over that too, so you can get a good idea of how accounting can be applied in a different organization. When we want to begin with an operating cycle of a business, it's generally the process by which a company spends money and also generates revenues for that organization. And the cycle of a business may be different for merchandising firms and for companies that sell merchandising products to customers directly. So the main point about a merchandising firm is that you fully understand the cycle and the process of how it comes from getting the product or purchasing it to the ultimate sale to a consumer and recording those various transactions and how they're a little different. The financial statements are going to be a little different too. It's not harder, it's just different. They might add more information. And it's important that service organizations and merchandising firms have very similar financial statements. Obviously the balance sheet and the income statement, and then the statement of cash flows, and obviously the statement of retained earnings or stockholders' equity. But when you look at those reports, they may have a different type of presentation, and that's what you want to really focus your eyes on when you're looking at the statements. So one of the things that you'll notice too, buying and selling of merchandise, and you're going to see on the income statement particularly, you're going to see sales, but you're also going to see cost of sales or cost of goods sold. And that's going to give you gross profit. This is not anything difficult, it's just different. So when you look at your financial statements for a merchandising firm, take notice of those differences and compare them to a service firm. And then draw some contrasting items, things that are not shown on a service firm's financial statements and things that are shown on a merchandising firm's statements, and how useful that information can be depending on what you're looking for in those financial statements. Also, merchandise that's not sold is going to be called inventory. We know this. You buy a lot of inventory. Merchandise firms like Walmart, like Target, purchase a truckload of inventory. And in fact, if you were to look at their financial statements, you'll find that inventory could be millions of dollars at the end of a period of accounting period. It's quite a significant amount of their assets on their balance sheet. As a result of that, it's important to note the flow of inventory and how they cost that information is going to be critical, which we will definitely talk about in chapter 6. So inventory is a current asset because it's going to be going in and going out. Obviously, inventory is an asset that is attributable to the revenues that organization generates. So it's going to be helpful to see that turn over very, very quickly. And the quicker it turns over, the more efficient the organization is generating revenues. Another difference is going to be the transactions and recording those transactions. So think about how the transactions that you've recorded in the past few chapters, and then think about the differences that you will see that relate to merchandising firms. There are differences, and it's important to see that difference and understand how it affects your reporting of information on your financial statements. It's not something that's going to be difficult, but remember, when you're recording transactions, sometimes the various different types of industries are going to make a difference in how those entries are recorded. Not whether they are recorded, because you're going to follow GAAP no matter what, but how they're recorded in the specific accounts that are affected will be the difference. Also, you need to make note of the different types of subsidiary ledgers. Remember, accounts receivable ledger is going to be a customer ledger. It's going to give you a lot of information specific to the customers that you have, who the customer is, what they purchased, when they purchased it, the amount of the sale, that type of information. Very, very detailed. Whereas when you see the financial statement, you're only going to see a total number that shows what the customers owe you. Same is true for your accounts payable. You're going to see accounts payable ledger with, on your financial statements, you'll see accounts payable and you'll see a dollar amount. But then the subsidiary ledger is going to show all the details, the vendors that you actually purchased items from and the amounts that you owe them and possibly the date and invoice numbers. So that subsidiary ledger is going to contain supplemental information, very detailed information that you will not see on your financial statements, which was very important. So these two subsidiary ledgers must most certainly tie into what's on the financial statements. They must agree in total. Although the subsidiary ledger has much more detailed information, in the end, if you add all your accounts payable invoices and you took that total amount, that number should directly be reflected on your balance sheet in the current liability section of your financial statements. But again, these are all subsidiary ledgers that provide you specific details of various transactions. And again, you will see only the high level information on your financial statements, which is your ending balance as of end of a period. So companies going to use separate journals to record these transactions. Again, depending on the transactions being recorded, will determine the actual journal that's being used. If you're recording a sale, you're going to record it in the sales journal. You're recording a payment of a bill, a disbursement, you're going to show it in the cash disbursement. If you make a purchase, you're going to show it in the purchase journal, and you can also show it in the accounts payable journal because you may purchase that item on credit. Again, these journals are very specific as to the transactions that are being affected. But again, if you're using an accounting software program, each one of these journals are electronic and you don't see them, but the accounting still remains. Purchases go in the purchase journal, general non-specific transactions go in the general journal, and then sales journals are going to record and reflect all of the sales activity in their subsidiary ledgers. Now, transactions are recorded in two different types of systems, and that's going to be periodic and perpetual. Obviously, a perpetual inventory system is most likely used by a Target and a Walmart and other large organizations where they're going to be recording and updating their inventory balances after every transaction, whether it be a purchase of more products or a sale of those products. A periodic is not going to show the amount available for sale simply because you're going to wait until it's sold, and you're usually going to take an inventory count. So a physical account is going to be really necessary when you're under the periodic, because on periodic is just that. You're going to be periodically, once a month, once a year, doing these physical counts, not every single time a purchase or sale is made. So invoice is going to have terms. Obviously, it's going to say the terms. When do you pay it back? When do you expect to pay back your accounts payable to your vendor? Net 30, net 10 days, or are you going to be provided a discount? Whether it means you will be able to pay it back, but if you pay it back quicker than the due date, you get a 2% discount or a 1% discount, that sort of thing. But the terms are going to really be what the obligations you have to a vendor to pay that back. What are their obligations? What are they asking from you? Not only they want you to pay it back, but how quickly they want that money paid back. And the same is true when you're dealing on the opposite side, on the seller side. But for right now, to encourage your buyers, or you or me, when we buy a product, to encourage you to pay it quickly, well, before the due date, in this case 30 days, they will give you a discount. So if you look down at the bottom, you'll see 210 net 30. That just simply means you will get a 2% discount if you pay within 10 days, or you pay the net amount due within 30 days. And you're going to see that quite a bit in the merchandising type transactions, where you are going to be given the opportunity to benefit if you pay quickly. And organizations like that, I mean, obviously they want to get their full amount that's due to them, but I would rather get most of my money faster than all of it later. And again, for purposes of monitoring liquidity and cash flow, that's very significant. And you're talking about thousands and thousands of dollars that could be receive much, much sooner, and will allow you as an organization to pay and buy other goods or services. So these discounts can actually allow you to save money for the purchases that you have. And on the other side, the organization that's selling it to you can get their money quicker. So it's a win-win on both sides. So again, you're going to be dealing with purchase returns and allowances. And again, when someone returns an item because either it's defective or doesn't meet the specifications, debit memos are also done. And those debit memos are just going to be letting you know, as a buyer, that you have been given a credit to offset your purchase because an item was returned. And we'll be doing entries to record those types of transactions. So it's going to be important to understand how those transactions affect the initial purchase, and how it flows onto the financial statements ultimately. Sales transactions are really the opposite side of the coin, to be honest. If Walmart, for example, purchases electronics and puts them in their storehouses for sale, they obviously have to pay within 30 days, but if they pay sooner, they get discounts. On the opposite side, when they sell those items or the electronics to you and I, they have to record, again, the sale. And revenue from merchandise sales is going to be called sales, or it could be called sales of merchandise. And again, the nomenclature is not so much strictly stated as is on the screen, because it really depends on the organization. They may very well use more specific terms to describe the revenues that they generate, but more than likely it's going to be something very close to what you see here. Cost of sales is going to be important in the perpetual inventory system, because we have to track the cost that we paid for those inventory items, and those items are going to be charged to cost of goods sold the moment we sell it. So therefore, you're going to see transactions when you buy the items or the merchandise inventory, and you're going to see transactions, or actually two transactions, when you actually record the sale. And we're going to go over that very soon. So sometimes you can sell your products or services by Visa or MasterCard, and these are really like a very, very liquid receivable, because you don't get the cash right away. You may get the cash within days. So for accrual basis accounting, we have to record an expectation of money, even though we've charged they charge the items to a credit card. We may not get that money for 3 to 5 days, depending on the clearinghouse and how long it takes for them to give you the money. But in the interim, we have to record the entry. So in some cases, we're going to show it as cash sales. Depends on how many days it takes. But some organizations will establish a receivable until that money actually hits the bank, which I believe is probably the most efficient way to do it. And also, you may have to deal with fees associated when you accept a credit card. Those bank fees, they are going to charge you a processing fee that gives you the privilege to accept payment other than cash or check. And it could very well be 1%, it could be 50 cents, but depending on the organization and the relationship they have, it's going to be a cost of doing business. But it most certainly, if you think about it from cost-benefit analysis, believe me, the small cost that you have to pay to accept a credit card is so much insignificant to the benefit of receiving your cash or your money right away from your customer, as opposed to getting a check or some other form of payment. Now, for example, if you're like a Walmart and you provide a discount to your customers, maybe to encourage them to buy more, discounts could very well be like a coupon. Now you see a coupon when you go to the store and you have $1 off your particular product. That's a discount. You're getting a discount. Discount in a form of coupons or something that would encourage the customer to act, to buy, and to buy now. And you have to deal with that. And again, sales discounts are going to be a contra revenue account. So they're going to be offsetting the revenue, the sales revenue. And you will see that difference on your financial statements, which is one of the many differences between a merchandising firm and a service firm. Sales discount, which is normally shown as a contra revenue account. So there's going to be some of the little things that you'll see that are a little different, a little added information on your income statement. Cash refunds and allowances, and again, some organizations sometimes net these differences into the line item called sales. But if it's material, you are required to show a delineated amount of the cash refunds or returns and allowances as a separate line on your financial statements under your revenue. And again, this is just a way to show that you owe some money to your customers, and until you pay it, it's a liability to you. And again, returns are the same way you would handle purchases. If a customer doesn't like the product that they have been purchased from you, you can also give them a refund, or you can actually charge against the amount that they have outstanding to you. Freight or other costs associated with purchasing and sales of merchandise. And again, these are just costs that you have to think about. One of the terms I think is going to be important is free on board, or free on board shipping point. And this just tells you that the buyer is going to pay the cost from the shipping point to the final destination. And your questions and your homework will most certainly give you an idea of whether or not it's going to be free on board, FOB destination, FOB shipping point. And really tells you when the title of the product that you've purchased, or what the customer's purchased, when it leaves the seller's hand and it goes to the buyer's hand. And that has everything to do with when you record the transaction, and what transactions and how the transaction is recorded. So knowing FOB shipping point, FOB destination, knowing that information is going to be very, very important when you're recording these transactions. Again, we're talking about accrual-based accounting, and we're talking about the nature of recording transactions when you've incurred the expense or when you've earned it. And FOB's destination, FOB shipping point, is one of those tools that you'll need to know in order to determine if the earnings process is being completed. Dual natures of merchandise transactions. Again, we are talking about two sides of a coin. One side is going to be the buyer side of the transactions and the entries that are relevant to them, and the other side is going to be the seller side of it. And it's important both for you to see how they look. Okay, giving you an example for the first one here. July 1, Scully sold merchandise on account to Barton for $7,500. FOB shipping point, net 45 days, cost of goods sold of $4,500. On Scully's side of things, they have to show the fact that they have a sale, but that sale is on credit. So we're going to increase our asset, accounts receivable, and we're going to increase our sales. But we're also going to show the actual cost of that particular inventory item and remove the inventory from our records, which is our cost of goods sold debit, inventory credit. But look at Bart's side of things, or Burton Company. All they're going to show is the inventory that they purchased and accounts payable to Scully. Let's go down here. On the next one, July 2nd, Burton Company pays freight on July 1's purchase. Nothing to be done on Scully's side, but the inventory, again, a merchandising firm using a perpetual inventory system, this is going to be the entry. We're going to debit the inventory, $150, and credit cash. Let's take a look at the next one. July 5th, Scully sold the merchandise on account to Burton for $5,000. FOB destination net $30. The cost of the goods sold was $3,500. So here we go again, debiting a receivable of $5,000, crediting sales, and we're going to debit account cost of goods sold and credit inventory. On Barton's side, we're just going to record our payable, which is our credit, and our debit to inventory. But on the 7th, Scully Company paid freight on behalf of the merchandise sold to Barton. So again, we're going to show it as a delivery expense of $250 and credit to cash. Barton Company has no entry to record in this case. And finally, on the 15th of July, Scully received payment from Barton for the purchase made on July 5th. Now looking at our July 5th, we have a receivable of $5,000, sales of $5,000, and cash $5,000, and accounts receivable credit of $5,000. On Bart's side, we're going to remove the payable from our books. $5,000 is a debit, and we're going to reduce our cash. Very typical entries from buyer to seller. Most important thing about these entries, before I go back to this one here, most important thing about the entries is knowing whose side of the entry you're recording. That can become very complicated and very difficult to fix. So when you read these transactions, be very careful of what the instructions are asking you to do. Whose side of the entry are you recording? Are you recording both sides, buyer and seller, or are you recording just the seller side? It could be very, very difficult to figure out what you've done wrong if you don't get through the basics of, I'm recording a transaction for the seller. I'm doing the seller side of the coin, which would be right here on the left side of the screen, or I'm recording the entry from the perspective of the buyer, in which case on the right hand side. This could be critical when you're trying to record the transactions to ensure that they're accurate, knowing whose side of the information, whose side of the transaction you're actually trying to record. In the case of your project, you're going to be recording it from the seller's point of view, not the buyer's point of view. So you'll be focusing mostly on the left side, which is right here. And that's important to note. Now, sales taxes, again, we have to deal with the liability associated with sales tax. Again, you're paying the sales tax to the government agency, but you're collecting it from the customer. So in which case, when you collect it from your customer, you're not going to put it in a revenue. You're going to establish a liability, in which case ultimately you pay that to the government agency. So that's important to note. Trade discounts are another issue that relate to merchandising firms that doesn't necessarily relate to a service firm. Wholesalers do have those, and it's going to be a wholesaler mostly that have to do a lot of trade discounts simply because of the volume. If you buy enough volume from an organization, they're going to grant you discounts simply because of that. Know how to record those transactions. But here is an example of that. And again, we're just trying to get you familiar with the type of transactions that are very specific to merchandising wholesaling firms, and how they're a little bit different, and how you have to really think things through when you're recording the transactions, and also how they look when presented on the financial statements. Now again, a multi-step financial statements is going to contain several sections, and we're going to look at that. I don't want to go through all of this. I just want you to look at the actual statement so you can see how these things are broken down. If you can look at the sales, you'll see these expenses and these different categories. Whereas when you had a normal organization that was a service firm, you just see expenses and then all of the expenses laid out, delineated. Where here we're actually taking income from operations and we're breaking them into selling expenses, administrative or general expenses. And that's just giving you an idea why the multi-step income statement provides more information. It does give you more detail, and it breaks things and makes it a little easier for you or others to read. So a single step, very, very easy to read, but it emphasizes total expenses, total revenues, very much a one-step approach, and there's nothing wrong with a single step. Most organizations do use a multi-step because they want to be more detailed and will provide more information for external users. Now again, adjusting entries for returns and allowances are going to be something you have to consider, and adjusting entries for inventory shrinkage. We won't see much of that in your project, but you may see some entries like that in your homework, and just be aware of that. Aware of the type of entries that are very, very specific. Closing out your accounts, your temporary accounts with your income summary, and closing out your temporary revenues and your expenses to income summary, and then closing your income summary to your retained earnings. And then also, finally, not forgetting to close out anything that was in your dividends accounts to retain earnings. Very important entries, and they're very, very similar. So after you close your entries, you're going to prepare a post-closing trial balance, and clearly a post-closing trial balance will only show your asset accounts, your liabilities, your stockholders' equity. And again, for decision making, understand the relationship with asset turnover. If you're talking about asset turnover as it relates to inventory, the more you turn it over, the quicker you turn it over, the more efficient and the more likely you are to generate sales. And it does have a positive indicator of your ability to generate revenues from your assets. And that's an important ratio to consider. I want to thank you very much for using this opportunity to go over the chapter before you read it, to get an idea of the type of things that you'll be looking for and the types of transactions that you'll be expected to record. The periodic inventory system is covered, and I would suggest you read through that, but I believe we're going to be really emphasizing the perpetual method, and I would love for you to see, for you to use at most of your time working through the type of entries that are required under a perpetual inventory system. And again, thank you very much for listening, and I will talk to you in Chapter 6.